Welcome to the IREL podcast. Are you sick and tired of real estate gurus pitching their next pre-construction deal, only to find out years later they were completely wrong? Worried the next overseas conference you spend thousands to attend will only be used to sell overpriced lots and deserted developments? Join thousands of other international real estate seekers who are looking for their place in paradise without the sales pitch. Straight from your host, Taylor White.
Hey, podcast listener. Welcome to the Overseas Property Insider Podcast. I'm your host, Taylor White. I am proud to say this episode is brought to your earbuds, courtesy of my friends at Trusted House Sitters. How else could you live around the world for just $7.49 per month? Wait, did I even mention daily email alerts of open homes, access to members 24 hours a day, and the ability to apply for as many house sitting jobs as you wish? We recently heard firsthand from full-time globetrotters and house sitters, Nat and Jody, about how they've been traveling the world, going from assignment to assignment at less than 25 cents per day. If you're interested in being a house and pet sitter at one of the thousands of open spots around the world, head on over to irelpodcast.com/trusted for more details. I can't wait to share David McKeegan from Greenback Tax Services, which specializes in U.S. expat tax preparation and coming to your earbuds from his current home base in Bali, Indonesia. David and I do our best to hit on the most need-to-know topics of strategies to legally reduce U.S. taxes by deducting vacation rental expenses, reveals a few countries that offer little to no local property taxes, some of the most important reporting time frames we need to keep in mind, and much more. Instead of telling you more, let's join David from the Greenback Tax Service headquarters. David, what's going on? It's Taylor White. I'm excited to have you on the podcast straight from the Greenback Taxes headquarters so we can get to know you personally. Tell us a little bit more about yourself.
Sure. Well, my wife and I are Americans. We've been living overseas since about 2002. We've got 2 kids. We're expecting our third. And, we've lived all over the world. We've lived in Spain, the UK, Brazil, Argentina, Uruguay, and currently we are living out in Bali, Indonesia.
So jealous. So David, I know that you guys at Greenback Taxes are experts in U.S. expat tax preparation. And if I'm not mistaken, you and Carrie started the company sometime in 2008 or so. Can you talk a little bit more about your company?
Sure. Carrie and I, we were living and working for big banks in the UK. And one of the big problems we had when we were living there was getting someone to do our U.S. taxes who actually understood how to do them for people that lived overseas. And so that was really the reason we decided to start the business, was to try and solve that problem for people. The way we're set up now, we've got about 20 CPAs or IRS enrolled agents working for us, and they do the tax prep. We've got another management team of about 7 people who are spread out around the world who help with, the billing, the marketing, setting up the logistics and everything like that. We're pretty much a virtual company. Everybody works virtual. Our headquarters is set up in Hong Kong, and that allows us the flexibility to keep our pricing low and also keep experts doing the taxes.
Hey, David, I'm curious. I first heard about you on the Tropical MBA with Dan and Ian, and I know that Bali, Indonesia is a huge hub for expats, and you've been to several spots in Latin America, Europe, Southeast Asia. How would you compare Bali, Indonesia with some other spots that you've been?
Oh, that's a tough one. There's so many wonderful places in the world. For us right now, we've got 2 little kids. So our older son is going to be 5 later this year, and the younger one's going to be 2 in about a month's time. And we were living in Argentina with them, and we absolutely love Argentina. But there's less for kids to do. So, if you're living in the middle of a big city, there's a bit less for kids to be doing.
Right.
Whereas over in Bali, we go down to lunch on the beach and the kids just play in the sand for 2 hours and you can enjoy a very nice lunch on the beach in Bali or, that kind of thing. So it's just a little bit more kid friendly, we've found, living in Bali than it was in Argentina. Of course, the unkid-friendly part is the 22-hour flight back to the U.S. to visit friends and family. But
Right.
my last trip back, I think I watched Frozen 5 times.
And then, David, the other main thing that I've heard about Bali, which this might be minor, but of course, if you run your business online, it's not, is the internet connection. Is that better today than maybe it was 12 or 18 months ago?
Yeah, it's much better now. At our house, in our home office, we've got 2 different connections, and both of them are 2 megabytes, and they're very solid. We haven't
Right.
had any problem with those. When we were there a couple of years ago, when we first moved to Bali back in 2009, I remember we were getting 14 kilobytes per second kind of thing. And it was enough to get email done and stuff like that, but it was a struggle to try and do any kind of call or anything like that.
I know it loud and clear. I was in the Dominican Republic and it was something like 0.10 or 0.15. So I know exactly what you're talking about. Okay, David, we're an overseas real estate podcast with a huge percentage of our listeners from the U.S. and have property located inside the U.S. as well as overseas. So why don't we first talk about choosing the best business structure for U.S. property investment?
Sure. Well, probably the most popular structure is an LLC. And, well, just to rewind, the reason you want to have a structure, some sort of corporate entity that holds the property,
Right.
is because of liability reasons. People are very lawsuit happy in the U.S., and if somebody trips and falls or something like that, you don't want them to be able to go after your personal assets. So if you do own an investment property, it's a good idea to have it set up in some sort of corporate entity, or you should really have some sort of liability policy, personal liability or umbrella insurance policy, just in case. But one of the most popular choices for investment properties is an LLC, a limited liability company, and they're pretty easy to establish. If you go to LegalZoom or something like that, you can set one up for probably between $200 and $500. They're pretty easy to maintain, depending on where it's set up. You may or may not have an annual state reporting requirement on it. But what happens is the information from that company passes through directly to your personal tax return. So you're not filing a separate corporate tax return and doing a lot of that stuff if you're using a U.S. LLC.
Hey, David, as a follow-up, let's say that you have a mortgage on the property. Would you still do a separate structure like an LLC for that, or is that only if you're paying cash?
Well, that becomes a slightly tougher question because
Right.
if the bank lets you do the corporate entity, it's probably still better to do the corporate entity. But if you're buying it, if you're going in and you're buying the property saying that it's going to be your primary home, but then you turn around 6 months later to rent it out, the bank probably won't let you put it into any type of entity.
Okay.
But it's still a good idea to have an entity, even if you have a mortgage.
And then I know it's a big question and it's always case by case, but let's say that you have a property in California, just as a random example. Would you do something like an LLC in California, or would you pick a different state to form the LLC in?
California is a tax problem in and of itself.
Right. Absolutely. That's why I picked it.
New York is the same. We've got a condo we rent out in New York. For California, you would probably have to have a California entity, but you might not get as much liability protection from an entity somewhere like California or New York as you would from an entity for properties in Florida or Arizona or something like that. But really what you'd want to do is talk about your specific situation with somebody that knows all the details of that specific state.
Of course. Okay, David, why don't we get to the crux of it? Let's talk more about foreign tax obligations.
Sure. Well, as anybody living abroad should know, if you have income, if you earn income and you're an American citizen, even living abroad, you still have to file U.S. taxes. So if you're self-employed, the threshold is $400. That's your filing threshold. If you're working for somebody else, if you're working and earning income, then the threshold is about $10,000 for a single filer or $20,000 if you're married filing jointly. So, that's the first thing people really need to know about. A lot of people hear about the foreign earned income exclusion, which allows you to exclude earned income while you're living overseas. And in order to do that, you need to either be physically present inside a foreign country for 330 days in a 365-day period, or you need to be a bona fide resident of a foreign country. We have a lot of information on our website if people want to have a look at that to get into the detail of those. Generally speaking, investment properties, real estate properties, will not count as earned income. Generally, they're considered passive income. So if you've got 3 or 4 investment properties in the U.S. and you're getting income from those, that's probably not going to be excluded using the foreign earned income exclusion. So that's very important for people to know and understand, especially when they're setting their budgets. You will still get the benefits of depreciation, mortgage interest, deductible, everything like that. But the income from those properties is probably not going to be excluded on your taxes.
So, David, a lot of investors, as a follow-up, have rental properties. Can you talk more about rental income and then those reporting requirements?
Sure. Well, the rental income does need to be reported on your U.S. taxes.
Right.
Now, if you've got a straight investment property, you have it rented out 365 days a year, then it's pretty simple. You just have to report it. If it's sort of a mixed-use property where you purchase the property as an investment property or as a vacation property, you're using it part of the time and you're renting it out part of the time, then it gets a little bit more complicated. So if it's used for more than 14 days a year or more than 10% of the days it's rented, then the IRS is going to classify it as a rental property and the income has to be reported. Now, if you're using it less than 14 days a year, then it's not going to be considered a rental property, so you wouldn't have to report that income on it.
And then, David, I'm curious, if you're a U.S. taxpayer, and let's say that you have a rental property in New York, just as a random example, is the rental income and the reporting requirements different if it's U.S.-based or if it's foreign-based if you're a U.S. taxpayer?
Yeah, it gets really sticky if you have a foreign corporation owning U.S. property, because you start to run into issues around sub-F income, which is basically passive income earned by foreign companies that are owned by Americans.
Right.
And that could be a whole separate podcast, but that's a real big tax issue for people, where all of a sudden you think things are going to be classified one way, but the IRS classifies them a different way because it becomes sub-F income.
Okay. And that would be if your foreign real estate is held in some kind of foreign LLC or corporation or foundation or trust.
Well, really, if you have any sort of passive income being owned by a foreign corporation, but specifically I was saying if you have like a U.S. property owned by a foreign company,
Okay.
you'd run into problems with that. If you have a foreign property that you're renting out owned by a foreign LLC or something like that, you could still run into sub-F income issues, but you can also run into FATCA issues, the Foreign Account Tax Compliance Act, because in all likelihood, the foreign corporation, which you own 100%, is going to be worth over the reporting requirements for FATCA. So it just adds an additional reporting requirement for you on there.
Okay, David, since we're talking about taxes, of course, can we talk more about ways to reduce our taxes by deducting expenses?
Sure. One of the most important things if you have a rental property is to make sure you keep track of everything you're doing with it. So any sort of repairs are deductible. Your startup costs, a lot of the time they can either be deducted or they can be added to what's called the basis of the property. So, the starting value of the property, and then you can depreciate the basis over the life of the property, or over 27 and a half years. things like mortgage interest or management fees, those are all deductible in your taxes as well. So what you can do, and the way people take properties and make them cash flow positive but tax losses, is you have mortgage interest and you depreciate the property, and you can add in repair costs, startup costs, all this other stuff as well. But you end up having a tax loss while the property is still cash flow positive in the beginning. Does that make sense?
Of course.
So, that's one of the things people do that really helps with investment properties. That's one of the reasons investment properties are popular and are tax advantageous for people.
Right. And then can you break down maybe a few more of the common expenses that can be deducted?
Sure. The most common ones are going to be repairs. Anything you do around the place. If you're changing tenants and you have to paint it or fix the locks or anything like that, keep track of those receipts, and those can be deducted from your taxes. Again, your mortgage interest, if you have a condo, any management fees, any sort of, if you're paying real estate brokers to rent it out for you, that can be deducted. And even travel expenses, to the extent that the expenses are tied directly to the management or the purchase of the property.
And then, David, talk to me more about what classifies as a receipt. Does it have to be original? Does it have to be signed by the person that did the work? Let's say paint the house. Can it be a credit card statement? Like, what's a receipt?
Generally, you want to have an invoice. So, if you hire a handyman to go in and paint the house, you want him to give you an invoice or have a canceled check or something like that. Credit card statements, they're not always the best thing because somebody might be processing through the credit card through, their brother-in-law's restaurant.
Right.
So then you just end up with a receipt for Joe's hot dog stand, even though you hired Fred to paint your house. Obviously the IRS wouldn't accept that. If you're living overseas or if you travel a lot, you can even just take pictures with your phone and then save them to your computer as PDFs.
Right.
And you can use those as receipts if you ever get audited or anything like that.
Okay, so I actually don't physically need a hard copy of the receipt, which is the original. I can put it to my computer. I can send it to a company like Shoeboxed. So as long as I have some kind of receipt that came from whoever did the work.
Yeah, exactly.
Okay, cool. So hopefully when we're investing in real estate, we might have some gains if and when it comes time to sell it. Can we maybe talk about some of the strategies that we can use to exclude any property gains on a sale?
Sure. Well, you're able to exclude the first $250,000 in gains or $500,000 if you're married filing jointly, on the gain of property. There's a couple rules you have to pass in order to do that. You have to have owned the home for at least 2 years during a 5-year period ending on the date of the sale. That's called the ownership test. Then there's a use test, which is the house has to be your main home that you've lived in for at least 2 years during the 5-year period ending on the date of the sale. So that's the ownership and the use test. And then, during the 2-year period ending on the date of the sale, you cannot have excluded gain from another house or another home that you've sold.
Right.
So those are kind of the three things that you have to pass in order to get this exclusion, this $250,000 or $500,000 exclusion.
And then, David, as a follow-up on that, does that house have to be in your own personal name?
I believe it does. I don't think that works for a corporate, for an LLC, but I'd have to double check that.
And then just curious, would this apply to U.S. real estate as well as foreign real estate if it was in your own name, just to try and simplify it?
It would, yeah. If you own your own home overseas, you should get this same exclusion, as long as you meet the tests.
Right. And I know it gets more confusing if we're talking about overseas or if we're talking about entities, but just in your own personal name.
Yeah. Exactly.
Okay, perfect. So then, David, why don't we move outside the U.S. and maybe list off some of the countries that you might know off the top of your head with very small or no property taxes?
Sure. There's a number of places with low capital gains or low property taxes around the world. But
Right.
places like Argentina, Belize, Nicaragua, Croatia, New Zealand are places that are popular with investors that also have either low capital gains or low property taxes or no property tax or no capital gains at all.
Okay, perfect. And then, of course, when we talk about low taxes or no taxes in that country, it doesn't necessarily mean that it would transfer over to the U.S., right?
Well, what would happen is if you're paying, let's say you sell a property in France and you have
Right.
some sort of tax on that property, you can use what's called the foreign tax credit to decrease the amount of gain you would have on your U.S. taxes from that property.
Right.
That makes sense?
Yes. David, it always gets a little too confusing. I'm curious though, if we're going to have some people on our team. I know that I've always been told you need to have a U.S. tax expert, and if you're buying and selling in, let's say, Panama, you should have a Panama expert. Who do you think that we should have on our team tax-wise? Is it just you guys at Greenback Taxes, or should we have like an expert in that country as well as U.S.? Kind of break that down for me.
Well, it probably really depends on the rules of the countries where
Right.
people are investing in. Personally, I don't know that much about the property rules in Panama.
Exactly.
But if you're an American citizen, you also need to know the other side of the equation. You also need to know the U.S. tax side of it.
Right.
And that's what we do. We handle U.S. taxes for people that live overseas. Whether they're property investors or self-employed or running big corporations or teaching English as a second language.
Right.
That's what we specialize in for those folks.
So like people for like real estate, as of for instance, wherever you buy and sell real estate or else have like vacation rentals, you need to have a local expert there. And then if you're a U.S. citizen, also some great people like yourself.
Yeah, exactly.
Okay, perfect. So, David, I've bought and sold real estate in Brazil, which uses the real, and I know that currencies, when you're buying and selling real estate, is a little tough. Can you talk more about how you think currency fluctuations might affect those buying and selling real estate?
Well, it can have a big impact because on your U.S. taxes, you have to convert everything into U.S. dollars each year. So, a couple of years ago, you'll probably remember it was about 3.5 or 4 real to the dollar.
I
So,
do remember.
yeah, it was great.
Yeah, exactly right.
So, you could buy a property in Brazil for, for ease of math, called 800,000 real, which was
Right.
$200,000. More recently, the real has shot up in value against the dollar. So that same 800,000 real property is now $400,000. So even though your profit, if you were to sell it in Brazil in reais, you would realize no profit there because you bought it for 800,000, you're selling it for 800,000. In US dollars, you realized a $200,000 gain. And so, you would owe tax on that $200,000. So, the currency fluctuations can have a big impact on, what happens to the property, but also on your U.S. taxes. So, we've seen people who bought properties in the Eurozone when it was like 0.8 euros to the dollar, sell them at a loss in the local currency, but have a huge U.S. tax burden because, the euro went up to 1.3, so it went up a huge amount in US dollars. But
Right.
in the local currency, they actually lost money. So they lose money in the local currency, but they owe tax in US dollars.
And then, David, like, is there any way to sidestep that? And of course, when I say sidestep, I mean like legally sidestep it. Like, as a for instance, well, I guess a property, and we're using Brazil as an example. The property is located in Brazil, but what if it was, I don't know, I guess I was going to say a contract, but the contract would be for the Brazilian property. So there's no real way to sidestep that, right?
Yeah, there's not a lot you can do about that. If you have any kind of foreign tax credit on the property, something like that may apply, but there's
Right.
really not a lot you can do to sidestep that.
What if the property is located in Brazil, just an example, and the contract's in dollars or else euros? And I know we're getting kind of technical here, David. I'm sorry. But would it matter if the property's in Brazil, or does it matter as far as the contract if it's priced in dollars or else euros?
Well, I guess if you're buying the property in dollars in Brazil, then you wouldn't
Right.
have a realized foreign exchange gain.
Okay.
but technically speaking, you wouldn't have a gain because you're buying it. In the example we were using, you would buy it for $200,000 in Brazil, and then you'd sell it for $400,000. So you still have that tax burden on that $200,000. But I guess you wouldn't. I guess if you're making Brazilian reais, that would hurt you more than if you're making dollars, if you know what I mean.
Right. I do know what you mean. Okay, David, I know that this is a big topic, but what are some of the major time frames that we should keep in mind as far as filing and reporting?
Well, for U.S. citizens, the main April 15th deadline is the one that everyone sort of has burned into their brain.
Right.
But if you're an expat, if you're living overseas, you get an automatic extension that brings you out to June 15th. It's actually
just 2 months, right? 60 days or something.
Exactly. Yep.
Right.
It's actually June 16th this year because the 15th is a Sunday.
Right.
And then it's pretty easy to file for an automatic extension that would get you out to October 15th if you need the additional time. So, a lot of people who live in the UK or Australia where they have different tax year ends need to do that because they don't get all their tax documents in time.
Right. And then, David, correct me if I'm wrong, and sorry to cut you off, but you still need to pay what you think your taxes are by April 15th, even if you have an extension. Is that correct?
Yeah, generally speaking, you want to get, if you think you need to make an estimated payment or something like that, you want to do it by the April deadline.
Okay, so that's still the deadline.
Yeah.
Okay, and then what about some other timelines that we should keep in mind, maybe as far as a foreign bank account, or I know some of the new laws that have passed like the last few years, we have a lot more documentation that we have to file. Maybe just a couple more things off the top of your head, time frame wise, some of the major ones that we should keep in mind.
Well, the real major one you need to keep in mind is the FBAR, the foreign bank account report.
Right.
So if you have over $10,000 in all of your foreign bank accounts combined, you need to complete an FBAR, and that goes into the U.S. Treasury, not to the IRS. And the deadline for that is June 30th. And there's no extension for that. So even if you get an extension on your taxes, you still need to have your FBAR in by June 30th. Now, the
David.
other one requirement that comes into effect is the FATCA reporting requirements, but that's part of your taxes.
Right.
So if you get an extension on your taxes, you would have an extension on the FATCA reporting as well.
Awesome. Okay, David, I would love to wrap up the call. And what are some final tips or strategies that you might want to recommend for people listening?
Well, if you're going to be buying property either in the U.S. or overseas, it's always good to speak to a tax professional beforehand, just to get the lay of the land, to make sure you're going to understand exactly how things are going to impact you cash flow wise and also tax wise. And then if you do buy a property, you want to make sure that you document every single expense that you can tie to that property, because you want to have that to either be able to deduct or to amortize over the life of the property. And then if you're buying a property abroad, you want to have a good idea of what the tax structure there is going to be like. You're going to want to know if there's a tax treaty between that country and the U.S. and how you're going to be taxed on that property according to that tax treaty. So, there's the biggest thing is probably keep really good records. And the second biggest thing is talk to somebody that knows what they're doing with this stuff.
I would say that's good advice, David. And then, of course, David, what are some of the best ways to follow and connect with what you guys do?
Well, the best thing to just have a look at our website, greenbacktaxservices.com. We actually have a guide on there for Americans who are living abroad and buying property in the U.S. So that's a free guide on our website if anyone's interested in that. But if people have questions, they can just write into us. We try and answer all the questions we get as quickly as possible. But the best thing to do is just get in contact.
Awesome, David. Thank you so much for coming on, and I hope we can do it again soon.
Oh, thank you. It was great.
Fantastic call today with David, straight from Bali, Indonesia, and I wanted to thank him for coming on the show and better explaining some tips and strategies U.S. expats need to keep in mind when dealing with their taxes. you can head on over to our site for complete show notes, easy ways to follow and connect with David, and more information about his fantastic company, Greenback Tax Services. And don't forget, if you're looking for fantastic ways to stay at amazing homes in the world's most spectacular locations, but don't want to spend a fortune, I encourage you to check out Trusted House Sitters. With hundreds of house sitting assignments just a click away, you could only be minutes from lining up your next overseas assignment. We heard firsthand from full-time house and pet sitters exactly how to do it on a recent podcast, and their most recommended resource also happened to be a guest on our podcast. Head on over to irelpodcast.com/trusted for more details.
You have been listening to the IREL Podcast with Taylor White. Be sure to hit up irelpodcast.com for more. That's irelpodcast.com. Thanks for listening.